to your first question a bit, it's very important that our listeners appreciate what moving from a debt to GDP ratio of 145% to about 70 something,
79,
right?
Yeah,
that's it's very critical to understand what that means. Because what it means is that when you have such a high debt to GDP ratio, ultimately what it means is that the government is through its borrowing activities crowding out private investments, right? And therefore your capital markets will not grow. But when you have 70 something debt to GDP, still fairly high, but for us, that's huge. A monumental accomplishment. I remember we spoke about this in summer of 2021 for us. We have some bragging rights about just this is the fruits of the institutionalization of economic governance.
Yes.
And that always is a tailwind for the performance of risk assets, right? So to answer your question specifically now, given that background, and remember, this is a forecast, by the way, so you don't have to, but based on the run rate, if everything continues as it is now, that is where we will land, right? It therefore means that you're right. It might mean that you see a reversal of the spread compression that we have been seeing, to the extent that the central bank backtracks on its restrictive or high interest rate regime. So that's a positive for financials. But we also have to keep in mind that increasingly we have seen, certainly in the securities dealer space, fees and commission income accounting for a significant percentage of your net operating revenues over the last 5 years or so, because of the large and small corporates tapping the debt capital markets, for instance, and raising funds through all sorts of means. The expectation is that with that stable macroeconomic backdrop, that could actually resurge. So you're seeing two particular line items there that could possibly be poised for further growth going forward. Your NIM and
there's also a feedback loop in that, because as you have more capital markets activity and there's a higher pool of assets, the asset management space, pretty much so that is the point. Once you have a stable macro backdrop, it opens a panoply of opportunities. That is essentially the idea. And so the final point that I would probably want to impress upon our listeners is that yes, there are some things that are circulating in the space just now that might cause people to be skittish in terms of putting their capital to work. That's one. Two, we haven't necessarily seen the confidence really return to the market that was there from 2019. Right? We really haven't seen it, particularly among the institutional investors and so forth, right? So what we're seeing is that given what we think are some fairly attractive valuations still on the main market, and there might be a few on the junior market as well, and a stable macroeconomic backdrop, now is the time for you to be, to be building up positions in these assets. We're thinking and speaking directly to investors now, right?
Yes.
Somebody who is into speculate and try to we can't know what but somebody who intends on building a portfolio to really generate wealth, now is the time to accumulate some of those assets. I mean, when we think about some really good blue chip companies trading in low single PE
We haven't seen this in a
years.
very long time. As a matter of fact, just before we saw these only in and around the time we were embarking on the first IMF standby agreement, right? And at that point, we were teetering on a fiscal cliff, right? Remember, there were anecdotes about when our politicians went into to Washington. It's almost as if they had to go there on their knees because we were pariahs in the international financial community. And if the article we saw last week is anything to go by, now it's like we are now like we're going back into Damascus. we're being heralded in, yes. Right? So I think there is ample evidence for us to be cautiously optimistic about Jamaica's near-term and even long-term future, and we need to begin to put our capital at work because they are very good assets, attractively priced, and we need to be building positions in those.
So you're bullish on Jamaica?
I mean, I think I'm on record as saying that, Raul, because I am big on institutions, right? And we have made tremendous inroads in building the institutional foundations that will keep economic governance anchored, right? So we're talking about the whole introduction of fiscal rules, for example. So there can't be no ministerial discretion. Again, that's a thing of the past. We have a central bank that is independent, right? I know people will have different views about perhaps their current posture and that kind of thing, but at the end of the day, it is very interesting that a central bank can stick to its position without any fear of political meddling, that kind of thing. That's a hallmark of a strong democracy, and that's critical for capital markets to grow and evolve. Right, so those are things that you keep in mind if your mindset is about building durable wealth. You need to have those things in place to ensure, because it will give you the full knowledge that your wealth is secured in a strong institutional foundation. That's where we're at.